Welcome to Clear Finance India. I am your host. Today, we are breaking down a fundamental pillar of domestic equity markets to answer a core question. How does the Indian stock market actually work? And what exactly is the Nifty 50? If you watched the market close this Friday, you saw firsthand how quickly short-term sentiment can pivot. The Nifty plummeted over 350 points in a sudden final hour sell-off, breaking below the vital 23,550 mark. Driven by late-day MSCI index rebalancing, a slight downgrade in the IMD monsoon forecast, and ongoing global trade updates, retail investors are understandably anxious. But times like these reveal exactly why a clear, algorithmic understanding of our market's baseline index isn't just a luxury, it is an absolute financial survival mechanism. Let's look under the hood at how the Nifty 50 is calculated. A very common misconception among retail savers is that the Nifty is a simple price average of 50 top companies. That is completely incorrect. The Nifty 50 utilizes the free float market capitalization method. This means a company's total corporate size doesn't determine its index power. Instead, it is determined solely by the value of shares actively available for public trading on the open exchange. Because of this specific methodology, each stock carries a highly distinct weightage. Heavyweights like HDFC Bank and Reliance Industries dominate the movement, holding massive individual allocations near 11 to 13% each. This means that if just a couple of these apex firms experience major institutional inflows or block deals, they can lift or depress the entire index, even if the remaining 48 companies stay completely flat. Understanding these structural weightages changes how you read daily market news. To understand where India stands right now, we must look at the global landscape, as indices worldwide are behaving in highly divergent ways. For instance, the US S&P 500 has continued its relentless earnings-driven bull run, regularly carving out fresh historic highs near 7,600. Over in East Asia, South Korea's KOSPI index has emerged as one of the most aggressive stories of the year, exploding upward to register massive multi-month surges driven by a historic global supercycle in semiconductor memory demand. Similarly, Japan's price-weighted Nikkei 225 has shown stellar bullish resilience, breaking records above 66,000 amid heavy foreign capital inflows. In stark contrast, Hong Kong's Hang Seng Index continues to underperform, sliding down over 3% this past month to consolidate around the 25,000 mark as it battles lingering real estate vulnerabilities and cautious global trade sentiment. This stark divergence is exactly why Indian equity, currently experiencing healthy consolidation at elevated valuations, remains a vital destination for structural compounding. This brings us to our primary wealth-building tool, tracking the Nifty through systematic investing. When you deploy capital into a low-cost Nifty 50 index fund or an ETF, your money is automatically split across those 50 top companies in exact proportion to their free float weightages. If you maintain a regular, unemotional monthly SIP, short-term drops like this, Friday's correction work entirely in your favor through rupee cost averaging. Market dips allow your fixed allocation to automatically scoop up more index units at a cheaper valuation, setting the stage for massive compounding when the macro cycle swings back to a rally. True money management demands that you shed emotional attachments to short-term market noise. Adopt a highly dynamic approach by reviewing your personal portfolio framework semi-annually. As your professional income streams grow, systematically increase your monthly deployment to outpace inflation and lock down long-term financial peace. To optimize your wealth pipeline this week, here is a practical, actionable tip. First, audit your investment style. If you want hassle-free, low-cost exposure that captures India's absolute economic growth, choose a passive, Nifty 50 index fund. If you want active managers trying to outperform that benchmark, look at diversified large and mid-cap active mutual funds, keeping a sharp eye on their exit loads and expense ratios. Investing is a long-term game of patience, mechanics, and unwavering discipline. Stay informed, stay systematic, and let the index do the heavy lifting. That is all for today's episode of Clear Finance India. Thank you for listening. Make sure to follow us on Spotify and YouTube, and we will see you next week. Disclaimer: this podcast is AI-generated content intended strictly for educational and informational purposes. It does not constitute formal investment or financial advice. Please consult a qualified SEBI-registered financial advisor before executing any financial decision.